now we're in a bear market, essentially. Certainly the NASDAQ is down 20% or more than 20% from its peak. And I always say to my team, it's darkest before the dawn. And I do think we're moving into some cathartic moments. We're certainly seeing the equity market rebel against what we believe is monetary policy that will end up being too tight.
Cathie Wood, the founder of Ark Invest and a stock picker, has observed the current economic and equities market volatility. She has put the responsibility for the current predicament on the Fed because she believes that the Fed hasn't learned from its earlier errors rather than toying with danger once more. Hey there, and welcome to Investing Wise Academy. I am Jules, and if you're new to this channel, please subscribe to be updated for more videos like this. Cathie claims that most people anticipate that the Federal Reserve's benchmark interest rate would increase tenfold from its original figure of 25 basis points to 2.5%. However, the Fed has increased rates 4 times, from 25 basis points to 1%. Therefore, it would be disastrous to raise interest rates in the upcoming 2 or 3 months by a factor of 10 from 25 basis points to 2.5%. Previously, in the late 1970s and early 1980s, Paul Volcker, the chairman of the Federal Reserve, doubled the interest rate from 10% to 20%. To address the growing inflation, one action was taken. A recession was brought on by the economy shock at the doubled interest rate. As a result, interest has increased 4-fold now and might increase 10-fold in the future. Therefore, the economy would suffer significantly because recent inflation is not just a result of problems with the money supply but also the supply chain. Cathie Wood argues that the Fed should review its tightening strategy and realize what's driving the inflationary spike. According to Cathie Wood, the current market condition is the darkest before dawn. She is confident that once the Fed's tightening program is entirely over, the value of shares will increase. Watch the entire video to get her perspective.
In the last month, the Fed did tighten up. We are now in the Fed funds range between 0.75% and 1%. So from basically 0 to 25%, we have, or 25 basis points, we've now gone, if you use the high end of that range, from 25 basis points to effectively 1. So up 4-fold. And the reason I'm giving that as perspective is we are beginning to wonder if one of the policy mistakes here is not understanding that we're starting with interest rates at such a low base that when you quadruple them or go up tenfold, which many people think the Fed will do before all is said and done, so going from 0.25% to 2.5%, that's a 225 basis point increase. That's up tenfold. We've already gone up 4-fold. And just hearkening back to the last time the Fed was fighting inflation and ferociously fighting inflation was under Volcker in the late 70s and the early 80s. And I was there, I was just starting my career, and I remember the Fed funds rate was at 10%, and Chairman Volcker at the time jacked it up to 20% in one move. So that was up 1,000 basis points, to be sure. That's a lot. And he did it to shock the economy. But that was only up 2-fold. We've already gone up 4-fold and potentially up 10-fold. And just beginning to wonder if, the impact on the economy, starting from such a low rate and having been at low rates for so long, that maybe this is, yes, a shock to the economy. And we're seeing M2 growth slowing. It peaked, I think, at about 27% and is now down to 8% on a year-over-year basis. But if you look at month to month, what you'll find is money has barely grown at all since January. That is very tight policy already. And now we're beginning, I think just yesterday, we began something called quantitative tightening. Now, I say we, it's the Fed started quantitative tightening. And what that means is that it is going to let some of the assets on its balance sheet simply roll off. It's not going to buy mortgage bonds or treasury bonds as it has been, just to replace those maturing. Many people think that quantitative tightening is a real tightening move. I think I just described the tightening moves. The quantitative tightening is nothing more than assets on the central bank's balance sheet, the Fed's balance sheet, that are going to roll off. They were kindling for what could have been an accelerated rate of bank loan growth, but they were never lit. And so they're simply going to roll off. So we don't think that is as significant as the actual tightening moves as it pertains to interest rate and money supply. Now, one of the fights, or the biggest fight that the Fed has on its hands, it believes, is inflation. And inflation has been much higher than we would have expected. And you know the reason. Supply chain issues for much longer, almost 2 years now, more than 2 years now. And then, of course, Russia invading Ukraine, really driving up food and energy prices. So the Fed is not happy with this, and no one's happy. In fact, the consumer is very upset, hasn't been this upset since 08-09. But we are beginning to see signs that inflation has peaked. And Chairman Powell did say maybe it did peak in March. We got the personal consumption deflator, which is the Fed's primary inflation indicator. It's the one they pay, to which they pay the most attention. The headline PCE deflator was an increase of 0.2%. So that's 2.5% at an annualized rate, roughly. And if we were back there on a year-over-year basis, the Fed would not be tightening. Nonetheless, to see that happening at the margin is really important, and the Fed should start taking some comfort from it. The core CPI, it pays more attention to the core CPI, was up 0.3%. So that's 3.5% annualized. It would like to get that down to 0.2 as well. But we have seen the year-over-year inflation rate in core PCE drop from 5.3% in February. So this measure of inflation peaked perhaps in February. March was a tick down to 5.2, and April down to 4.9. And if those sequential numbers are any indication, that rate will continue to come down over the next year or so. The other prices that the Fed is watching, I think, are copper. Copper is a very good indicator of what's going on in the economy. And that's the global economy. We know that Europe and China are practically in recession, if not absolutely in recession. China's easing to try and take some of the pressure off. But I think oil prices might be the more important price, mostly because of how they impact consumer sentiment and inflation psychology generally. So oil prices did kick up this last month again. We still didn't get back to the peak. Right after Russia invaded Ukraine, oil prices got into the 130s per barrel. And we're now down to 119, but we have been down below 100 very recently. So it's kicking back up, and it will influence the inflation metrics. Not so much the core PCE, because core excludes food and energy. And this metric was, I guess it was designed or derived in the 70s when oil and food were very, very volatile and often misleading in terms of where inflation ultimately was going to go. So we shall see what happens. Oil is influenced by a cartel. We do believe there's serious demand destruction taking place at these price levels. You can see around your own communities, there's either less traffic or that you'll see more bicycles, scooters, and so forth. And we do believe, and we've been saying this for some time, that oil demand globally probably peaked in 2019. It is the supply shock that is driving prices up, and is also going to, or has accelerated the consumer preference for electric vehicles over gas-powered vehicles. So we do believe that this oil price increase is sowing the seeds of its own demise in the form of demand destruction. And when we say oil demand peaked in 2019, we mean it peaked. Many people used to use this concept, peak oil, when they were talking about supply, thinking we'd run out of it. Instead, we are using it in the form of peak demand, the demand destruction and the shift towards energy conservation in all kinds of ways. So that's monetary policy. We think the Fed is probably overdoing it. I think that certainly in terms of its intention to go up another 2 or 3 50 basis point increases. The market's railing against that, and it is perhaps because of this very low base that I mentioned in the beginning. We've already gone up fourfold from the low, still at a fairly low rate, 1% on the Fed funds. But the market seems to be saying that this is more than just letting the markets work and letting interest rates go up. The economy may not, the global economy may not be able to take too much more.
Before you leave, if you want to support this channel, you might want to try our Super Thanks, wherein your comments will be highlighted, and join our membership program to continue supporting this channel and our content. Don't forget to give this video a thumbs up and stay tuned for more upcoming videos like this. Again, this is Jules. Thank you for watching and see you on the next one.